Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, August 15th, 2017. It's about 4:30 Eastern Time. Markets are now closed, and wanted to do an update on gold and the U.S. dollar and the euro. I was going to post a couple static charts today, but I have some mixed thoughts on the near-term direction in the dollar and gold. But there are some interesting developments worth noting, so I just wanted to share what I'm seeing and let you guys sort through the charts and maybe it'll help you with your own analysis. This is starting out here, we're looking at a 4-year chart comparing gold in black to the US dollar. I've covered this charts many times in the past, but I know there's always new people coming into the site. And my point being, any analysis on gold, in my opinion, is remiss without or incomplete without looking at where the US dollar is likely heading. So if you look at this chart here, now it might not pop out to some, but what we're looking at is an inverse relationship. Now don't pay so much attention to the differentials in price, but the point being when the US dollar goes up like this, you see gold fall over that same time period. And when the US dollar falls, you'll see gold rally from that point and vice versa. So the correlation is very clear. Now it's not always a day-to-day correlation. So if you're watching tomorrow and you see gold and the dollar both trading down, don't be surprised. But it's the trend, the larger trends. And that's because gold, at least over here, is priced in U.S. dollars, and it's traded that way. So there's a very tight correlation. And if you're not a very visual person, sometimes this might help. I've done this before as well. If we compare it with UDN, now I was using UUP. I could use a U.S. dollar index. That's just the ETN that tracks the dollar. Now I clicked on to compare gold to UDN, which is the inverse dollar ETF, and you can see almost a near perfect correlation. Now, it's not a one-to-one again because gold is going to move in X percent in a given day, and the dollar may move in a smaller increment. The gold's going to move usually in larger price percentages. In any given day than will the U.S. dollar. So therefore, again, when you're trying to look at any two securities to look at the correlation and get a visual, look at the direction of the trend. Are they moving in the same direction at the same time? And that will show you. So you can see here, it's a extremely tight correlation. So again, I just wanted to spend a little bit of time on that. For those of you who haven't seen this chart, you can look at these on your own as well. Go back any time period, and you'll see pretty much the same thing. All right, now let's dive into the charts of gold. Little update here. Not much to update since my last analysis. Over the pretty much throughout 2017 so far. We had a strong rally in the beginning of the year. It kicked off at the end of 2016, and that's been plagued or marked, I should say, not plagued, marked with a series of divergent highs, which warned you of an impending trend change, followed by a correction. And there's also some pretty nice uptrend lines. They all have about the same slope too. If you look at that, all of these trend lines so far have about equal slopes. However, I pointed out there's a little bit of difference here. This most recent high, I should say we fell a little shy of the previous high. So first and foremost, we cannot have negative divergence because to have negative divergence on price, you need to see prices making a higher high with your indicators, your price and momentum oscillators down here making lower highs. So had gold made another high, we might have had we would have had negative divergence or would right now, but that wasn't the case. You can see. So we fell just shy of the previous reaction highs. I can say close enough. It almost looks like a triple top there. We're down below the trend line. We had a few false breaks either way, so we might want to extend this trend line out now at this point since I originally put it up, and that captures more of the most recent reaction. So let's keep an eye on that. We'll keep an eye on things. At the time I had mentioned back here when we were back right about here recently, I said we weren't quite overbought yet, and now we did hit that 70 level overbought on the RSI. I talk about this a lot. Um, if we are in a new bull market for gold, if the bull market or the bear market, I should say, ended back in late 2016, and this is the early stage of a new bull market, which I can make the case for that, then your expectation would be that overbought becomes more overbought or stays overbought for an extended period of time. In other words, we might hit the 70 RSI, pull back a little, continue to hit it. That is typical in a bull market, just as in a bear market, as you see back here, oversold can become more oversold and tends to stay oversold for a longer period of time. And for those of you not familiar, I'm using the RSI 14, and any reading 30 or below is considered oversold, whereas a reading of 70 or more, the red line, is considered overbought. So those are things that I'm looking at. And again, you always have to, or at least I do, I jump back to the big picture here. This is a 10-year chart in gold. The bull market even goes off to the left of this chart. I'd have to zoom out a little farther in time. But that was the top of the bull market in gold back in 2011. And it had a heck of a correction from that point. In percentage terms, it dropped almost 50%. It's about a 46, 47% drop from the highs to the lows. So this whole thing here was a bear market in gold. Hard to argue it in percentage moves. I have Fibonacci retracements. This was a buy zone that I had when we were on the way down, and we hit that 61.8 fib retracement of the bull market move up. So there was some, I believe it was a fib cluster there as well. So the case can be made, and we also had this bullish falling wedge pattern here. Let me take away that line and just kind of go over the long-term analysis, because I do think that is important. I do believe it plays into your shorter term analysis, depending if we're in a new uptrend, primary uptrend, or a downtrend still. So there was the contracting price channel. We broke out above it. We had a move up, initial thrust up. We came back down and we back tested it, and it was a successful back test, meaning that once prices hit that trend line, it held, it acted as support, and we bounced and moved up. So as of now, if we just take a look at where things are from, again, this longer term perspective, this was a significant level. I have numerous reactions. If you look along the chart to the right and left, you see a lot of candlesticks that stopped there and we bounced. It was resistance there. We briefly came above it here, but once we fell back below, it has continued to act as resistance. So this was just we'll call it a little whipsaw, a little pop above that level. But if you go to the left of that chart, spanning back years, so 5 years or more, or actually go all the way back to 2010, you can see numerous reactions there. So I think this is a pretty important level in GLD, and it will obviously be bullish if we can break above there, and then even more bullish if we can break above these previous reaction highs. So that's the longer term. My primary scenario is that gold is in a new bull market. And we're at resistance right now. We've been consolidating. That can provide us, potential energy for a breakout. Consolidations always work that way. They're going to break one way or another, and the longer you consolidate, typically the more potential energy is built up. And so we could see a nice rally to the upside. And that is my expectation, ultimately, a breakout to the upside. And if the other thing happens, meaning a break to the downside, then I'll have to adjust my analysis at the time. Trend indicators are bullish. PPO is above zero line. That's one of my trend indicators. When the PPO, I look at the 9 EMA, when that's above, the trend is bullish. When it crosses under, the trend is bearish. There was a little whipsaw there, but we had kept you short all along here, and it kept you bullish here, kept you bearish there. And if you look up above, just follow it above. It's done a really good job of defining the trend. So overall, right now, until and unless proven otherwise, gold is in a new bull market, at least in my book, folks. All right, so that brings us back to this. I'm looking for ultimately an upside resolution of this range, but we are in a range, and until and unless we break out of that range, you have to respect that. So part of this, I guess the driving message I'm trying to make in this video is I'm cautiously bullish on gold right now, but I'll say this: when I can make, if I can't make a strong argument to buy or short a security, if I can make a good case either way, both ways, bullish and bearish, or I'm seeing some conflicting evidence, I don't make the trade. Why do that? Trading is tough enough as it is. If you sit there and try to, force a trade just because you want to be in gold, catch the next move up, but you see some conflicting analysis, chances are it's going to ruin your success ratio there if you do that too much. You might get you'll get lucky sometimes, but it's more of a crapshoot in my opinion. So I like to let as many factors line up, either bullish or bearish, before taking a trade. So that's where we are right now in gold. We're still in no man's land. We need to see a breakout here, and more importantly, I've spent enough time on that. Let's jump over to the euro now. US dollar and euro. I like just tracking the euro US dollar pair. And that's what we're looking at here, EUR/USD. So when this goes up, when this chart's rising, the euro is rising against the dollar. And I won't spend much time on it because I did this in recent videos. I talked about this yellow shaded area here. It was a multi-year, 2.5 year sideways trading range, very powerful. If you flip this chart upside down, I also covered that on the dollar index here. I'll show it to you here. And for well over a year now, maybe going on 2 years, I've talked about this range, and I stated my expectation all along was to see a downside break. Now the dollar's just holding there. You can see the dollar just holding its support. Now keep in mind, the euro, although it is by far the largest component of the US dollar index, I think it's 50 something odd percent, 56 maybe, I don't know, I'll have to look it up. But it's over half of the dollar index, with the yen being a distant second at like 20 something percent, and then everything else behind there. So what I'm getting at is the charts are not going to be exactly mirrored when you flip them over. And what we have here is we have the dollar at support while oversold. And initially, when I was talking about the breakout in the euro last week, my expectation was for a mild pullback, and so far that's what we've had. I'll get down to the 60-minute charts in a second. Um, Now, here's the thing. So I'm pointing out, I just highlighted the 3 instances in the last decade that the dollar index was oversold, meaning we hit the 30 level, that blue line on the RSI. And you can see what happened each and every time. That was here, here, and now here. So, well, at least going back for a decade, this is what we had. Immediately following, well, I should say we had a couple tags there, not immediate. I mean, we could stay overbought, oversold here. This is a weekly time frame. We could be here for weeks, even months. But within relatively short order, we had a strong rally off that level because that came on the heels of an oversold rally. I'm sorry, oversold correction. Then again, we became overbought. As you can see, everything's circled here and corrected till we became oversold again. There's that second oversold reading. That led to not only that rally, we went sideways for a couple of years. Then we had another strong leg up. So really from this reading here, we had this one big rally to where we just recently ended up. Okay, that's a lot of blurry lines on the chart. Let's clear those out. One of the primary factors for my longer term bearish outlook is this huge, clear, powerful divergent high in the dollar index. It certainly has played out for a correction so far. The question is, are we too oversold right now at this point to break down and continue lower to this next support level or target that I have down around the 89.50 level? Here's where it gets a little tricky. If the recent breakout in the euro US dollar pair that I showed you sticks and it has some legs, we're going to go a lot higher, and we'll probably have embarked on a new bear market in the dollar index. Technically, that bear market would have started back here, but I mean, we'll continue lower. This will prove to not just be a correction and an ongoing bull, but the first leg down in a bear market. Now, if that is the case, you can expect that from this point forward, oversold will either become more oversold, meaning go deeper down below the 30 level, or stay oversold for an extended period of time, because that is typically what happens during primary downtrends or bear markets. Just as I often say, during a bull market, overbought can and often does become more overbought and stays overbought for an extended period of time. So, if you want to go on the assumption that the U.S. dollar is still in a secular bull market, then by all means you want to start positioning long now for a trend trade, not a swing trade lasting a few days or weeks or months, but a trend trade lasting many months, possibly years, because that was a case back here. And if you're of the mindset that the dollar index is probably top back here, then maybe a best case scenario, you're looking for a little bounce off this support level here, the bottom of this range. Maybe we go up, put a big head and shoulders pattern in, with this being your left shoulder, or actually two left shoulders. If you look at this over here, I just made a mess of that, but then this would be your head right here. That's one possibility. So we'll be on the lookout for all of these. But we do know that the risk reward right now is not very attractive because we're at support and oversold on the daily time frame. Now let's go back to the euro US dollar and we'll wrap it up there. All right, so this is the weekly chart. There's that big base that I talked about, the basing pattern. There's the breakout, very impulsive. These were just intra-week pops above the pattern that you can see that because these are candlestick wicks. These little shadows are called, or shadows or wicks, and when they're up top right here, that means we popped through their intra-week, but we couldn't make a weekly close. This was your resistance, the top of the zone. And so as you can see, we not only broke out, we did so impulsively, and it's been, I'm sorry guys, this screen capture software gets a little buggy sometimes trying to grab one tool. I'm trying to highlight the breakout now. We've had several successive candles. So far this week we're down, but again, it's early in the week, so anything can happen. So there it is. Dollars at support. Euro versus the dollar has broken out. And, one possible scenario, and it would be a little painful for the gold trade, is to come back in and back test this pattern because we are so overbought. If you look how overextended we were, I'm not a big fan of breakouts that come after an extended move without any pause. I would have much preferred to see us come up here, test the top of that range, come back in, work off those overbought conditions, and then power on through for a sustained rally. So at this point, because the euro spent so much energy, expended so much energy just to break out, it may need to come back in and back test and then be off to the races. And that would also roughly jive with that bounce I just showed you in the dollar index, bouncing off support, going up a little bit, maybe all the way to form a right shoulder. That would take months. If so, maybe not. Either way, we'll watch it as it trade it as it comes. And again, that whole thing that I said about overbought versus oversold. Remember, this is the euro US dollar, so this is really an inverse of that dollar index chart for the most part. And it shows you here that overbought, especially during a bear market, because the euro US dollar index or pair was in a downtrend, the euro was in a downtrend against the dollar, that when you had these overbought readings, I'm circling each one, they proved to be very fleeting, and they were almost by themselves. They would have been almost standalone sell signals. You can see you would have profited very well trading, the euro just on overbought conditions. So here we are, we're overbought. Are we going to see that again? Certainly, if we're still in a prolonged bear market. Thing is, I don't think so. I think the dollar has topped against the euro. At least as of now, that's my analysis. It has been for a while that would happen. We were in this range, we broke out. Therefore, we may continue to become more overbought here or come back in a little bit. That's what I think I'd prefer to see. Come back in a little bit and then make another thrust up, another overbought reading with the next leg higher, sort of what I've mapped out here. So that's from a long-term perspective. Daily chart, here's a pretty well-defined uptrend line off the April lows, you can see. And the question is, now I believe I pointed this out. I was composing a post today. I'm sorry, I had a lot of stuff going on today, and I started to compose a post, and I realized I was going to give you guys some static charts, but to do so, there are too many thoughts, too many variables here to just try to put up 2 or 3 charts and type a paragraph or two. That's why I'm doing a whole video. We can see that we haven't visited this trend line in a while. In fact, the last time we've had 1, 2, and we've yet to have a third tag. We don't have to tag it right away. Sooner or later we will. This trend line will need to be visited, especially to be validated. So far it only has 2 tags, so it would really become more valid if we got a pullback, tagged it, and saw another reaction there. I like to say it takes 3 reactions to validate a trend line because any 2 points can be connected at random. So, but it does have a nice appearance. It's at the usual slope of an uptrend. Some are not as steep, some are a little bit steeper. Either way, something to watch. And we also have support back here, which is also the top of that range I was just showing you on the weekly chart. So that's that back test scenario. We come back in. If we fell soon, we could back test both the trend line or test the trend line and back test the top of that long-term trading range here. So that is, I wouldn't put money on it, but right now I'm leaning towards that scenario. And again, I'm stepping aside because my conviction's not strong. Again, we didn't have negative divergence, so we may thrust up again to make another high before we come back in and test that trend line. But for now, that's what I'm looking at. 60-minute chart looks pretty good so far. This is a 60-minute of the euro US dollar pair. You can see, I pointed this out recently. We had a rising wedge here, this line in this line. This was your uptrend line. This showed the divergences, negative divergence. There was a high. We broke down. I had pointed out even in advance of the breakdown this minor uptrend line here, smashed through that one, and then went on to take out the primary uptrend line without even blinking. So we broke down from the wedge. It's been an impulsive move higher. We put a divergent low here, and this one looked good because, as I said earlier, I was expecting a shallow pullback due to that breakout in the longer term, the weekly charts. And from there, we did rally in gold, and the miners caught a bid. However, that rally peaked out at that point, went on and took out the lows by a slight amount. Now, all that did is really put in a larger divergent low so far. You can see we've turned back up here. The PPO is now pointing back up. And you can see down below all these, we have positive divergence. So we could go on to rally here. These 60-minute charts, if I was trading in a vacuum, only trading these 60-minute charts, I would say it looks good. The correction's probably over, and it may be. We've corrected more so in time than in price in this case. You can see here, and that's healthy price action for the euro. But until and unless we take out those recent highs, might be a little bit too early to say that the correction's over, but it could be. Anyways, that's my thoughts, guys. I'll keep you posted if I see anything else. And by all means, if I haven't updated a chart on gold or the dollar, and this holds true, by the way, to commodities, a lot of especially the ag commodities I'm looking at and some other things, they're also very dollar sensitive as well. So, I'm putting up a lot of analysis on the commodities. I just put one official trade I did yesterday. I'm considering pulling the trigger on wheat, but just trying to wait and get a little more conviction on where the dollar's going before I do that. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.